This lecture is over the features of stock. I'm your professor, Dr. Stephen Haggard. First, let's talk about the features of common stock. Common stock has no preference in dividends or assets at liquidation. In other words, the common stock holder is a residual claimant at the corporation. They get the leftovers. So what's the first thing that people usually think about with common stock? Well, it's called dividends. And this is a payment made by the firm to the holders of common stock, basically a distribution of some or all of the earnings. Now, what do we know about dividends? Well, dividends are not a liability of the firm unless declared by the board. Now, firms may pay a dollar dividend every quarter, but they're not required to. They could stop paying that dividend and the shareholders could not demand it from them. The shareholders could not push the firm into liquidation as a result. In fact, only when the dividend is declared by the board does it become a liability of the firm. At that point, if the firm did not pay the dividend, then the shareholders could force the firm into bankruptcy. But that begs the question, why would a board declare a dividend that they could not pay? The answer is that they won't. And further, why would a shareholder, if the board did such a thing, push the firm into liquidation? Undoubtedly, the chances of recovering any money at that point would be fairly low. Another thing you need to know about dividends is that they are not considered a business expense and therefore are not tax deductible. Recall that interest is considered a cost of doing business, and it shows up above the calculation of taxes in the income statement. Dividends, however, are considered a distribution, and they happen below the calculation of net income. Therefore, dividends are not tax deductible. Dividends are also taxable by the people who receive them. Individual shareholders pay a dividend tax. In the United States currently, the dividend tax is 15%. In the past, dividends have been taxed as regular income. The current top regular income bracket is around 35%. Given the budget situation in the United States, it is likely that the regular income taxation of dividends will return at some point in the future. Corporations, however, have a 70% exclusion on dividends. In other words, if they receive $100 in dividends, they can exclude the first $70 from taxation, and they only have to pay taxes on the remaining 30. If the corporation owns more than 80% of a subsidiary firm, all the dividends that the firm receives from the subsidiary are not taxed. Now, at first this may seem unfair, but it makes sense. Corporations have to pay corporate income tax, and if they had to pay taxes on the dividends from subsidiaries and then they turn around and pay those out, we would wind up with triple taxation as opposed to double taxation. So the subsidiary pays corporate income tax, then pays the dividend. The second company would have to pay tax, and then finally the shareholder receiving the final dividend would also have to pay tax. So that would be triple taxation. Apparently double taxation is just fine in the United States, but triple taxation is looked upon poorly. Okay, now let's look at some rights that common shareholders have. First of all, they have the right to vote on stockholder matters of great importance. What kind of things might be of great importance? Well, the board of directors. The shareholders elect the board of directors. Also, the shareholders have a right to vote on mergers and acquisitions in many cases. And so we see lots of things that the shareholders get to vote on. In fact, being an equity owner, one of the rights that comes with that is control of the corporation. Shareholders exercise that control through their voting. They vote in the board of directors, and then the board of directors is supposed to run the business on behalf of the shareholders. One of the rights that shareholders in the United States have is proxy voting. That's the ability to either give someone else the right to vote your shares or to vote your shares without attending the shareholders meeting. You simply mail in a proxy ballot. For example, my father owns shares in Walmart stores, and he lives only 90 miles north of Bud Walton Arena, where the annual shareholder meeting is held. But instead of getting in his pickup truck and driving down to Fayetteville, Arkansas, and attending the meeting to vote his shares, he simply marks his proxy ballot, which he received in the mail from the company. He marks it and drops it in the mail, and that is how his his shares get voted at the shareholder meeting. Now, this is a right that we Americans take for granted, but in fact in other countries it's fairly rare. For example, if you live in France and you own shares in a French company, you must appear at the shareholder meeting in order to be able to vote your shares. Now, picture a dairy farmer in Marseille. Marseille is in the south of France, and the dairy farmer wants to vote his shares in Total, which is a French petroleum company undoubtedly based in Paris. Would the dairy farmer give up a day's worth of milking of the cows in order to jump in his car and drive to Paris and vote his shares? No. And so in countries like France, we see much poorer representation of minority shareholders on the board of directors. Now, another right that shareholders have is to share proportionally in all dividends paid to common shares. In other words, if I own 10% of the common shares, then I should receive 10% of all the dividends paid to common. And finally, I have the right as a common shareholder to share proportionally in all assets remaining at liquidation after the liabilities have been paid off. Remember that common shares are a residual claim. Everybody else must be paid off first. But if there's any money left in the bucket after those people have been paid off, then I am entitled to a proportional share of those assets. If I own 10% of the firm, then I would have 10% of the residual cash after liquidation. Now let's talk about how voting occurs for common shareholders at corporations. And the choices are either to have cumulative voting or straight voting, and the choice will be spelled out in the corporate charter. Now, straight voting is what you typically think of. When a director stands for election, they stand by themselves. There's not multiple director slots being voted on at the same time, only one slot at a time. And so basically, minority shareholders would get no representation on the board of directors under straight voting because the majority shareholders would always be able to elect all directors. Now, cumulative voting is a little different. In this case, each share gets one vote per director being elected, but multiple directors stand for election at the same time. Shareholders can put all their votes on one of the candidates or can spread them across candidates in any way they see fit. And in this way, minority shareholders can get representation on the board. How? Well, let's say there are 4 directors standing for election and I have 1 share. That would give me 4 votes. I could concentrate all 4 of those votes on one race to try to get my representative elected. Whereas if we were doing straight voting and I'm a minority shareholder, I would not have that sort of option. So once people learn about cumulative voting, then they start to ask, well, how many shares must I own as a minority shareholder in order to elect 1 director? Now, first of all, let's answer a question here. Is getting 1 director elected something to seek? The answer is yes. Even if a board has 12 people on it, typically boards are composed of people who may or may not have any idea about the industry that the firm is in. And so there will probably be a former Army general or Navy admiral. There will probably be some lawyers, probably a director of a charitable foundation, among others, on the board. And these board members, although they mean well, may not have lots of knowledge about the business. What if you were able to elect a subject matter expert to the board? Might that one person be able to persuade the other board members to vote in the way that you want them to? Perhaps so. Otherwise, what is the tendency of directors? The tendency is to go along with management. So, now that we've answered the question that it is important to be able to elect one director, let's see what it takes to be able to do that. We have a formula. It's 1 over n plus 1, and we multiply that by the number of shares outstanding, and then we have to add 1 share. So n here is the number of directors standing for election simultaneously. So if there were 4 directors being elected simultaneously, n would be equal to 4. Let's work an example to show you how to do this calculation. The firm has 10,000 shares outstanding. 3 directors are up for election. How many shares must you own to guarantee that you can elect 1 director? Well, we've got the formula from the previous slide, and all we need to do is put in 3 for n and 10,000 for the number of shares outstanding. Well, basically we're looking at 1/4 of 10,000, which is 2,500, plus 1 share. So the answer is you must own 2,501 shares to guarantee that you will be able to elect 1 director. Now let's talk about classes of stock. Although rare in the United States, some firms have more than one class of stock. Now these different classes will have the same cash flow rights. In other words, if I own 10 shares of any class of stock, I'm guaranteed the same share of the cash flow. But they'll have differential voting rights per share. And the most common examples that we'll use here are Ford Motor Company, which has 2 classes of shares, and Google, which has at least 2 classes of shares. Now let's talk about Ford Motor Company. There are certain shares that have superior voting rights. So perhaps maybe they've got 10 votes per share. Now, do you think they'll let just anybody own that class of shares? No. You must be a direct descendant of Henry Ford or a charitable foundation founded by a direct descendant of Henry Ford. And so we see that this is how Ford still has someone with the last name Ford as the chairman of the board 100 years after the founding of the company, even though the family does not hold a majority stake. They're able to control the company with only a minority stake because of the superior voting rights of their shares. Now, let's say that you managed to make good friends with a member of the Ford family and offered to buy their shares. Immediately, if they sold their shares to you, those shares would lose their superior voting rights and would just be ordinary shares. And so this is not control that you can buy if you are not a member of the Ford family or a charitable foundation founded by a member of the Ford family. Now Google, that's a fairly new corporation. When they went public, they set up 2 classes of shares. Even though in their initial public offering they only sold a minority stake in the company, they still set up another class of shares that can only be owned by the founding members of the firm, and those have superior voting rights. This is so down the road, if the founding members decide to sell off their stock, some of their stock, perhaps to buy another airplane or a house, then they could still control the firm even if they only wind up with a minority stake. Now, is this good for the other shareholders? The answer is no. And the best example of this comes from Mexico, where Carlos Slim was able to purchase Telefonos de Mexico, which is the Mexican national phone company, from the government when they were doing some privatization. And Carlos set up Telefonos de Mexico as a corporation where he owned a class of shares with superior voting rights. This allowed him to control Telefonos de Mexico with a minority stake. And here is how Carlos managed to use that to get rich. Carlos would use his superior voting rights to force Telefonos de Mexico to sell assets to a company that he wholly owned. And let's say the assets were worth $1 million. He would have them sold to his company for $500,000, and his company would sell them back to Telefonos de Mexico for the full price of $1 million. Now this led to a loss of $500,000 at Telefonos de Mexico. Why isn't Carlos Slim upset about this? Well, let's say he owns 10% of Telefonos de Mexico. That $500,000 loss, he's going to bear $50,000 of it. But in the wholly owned company, the one that he owns 100% of, he made $500,000. And so he has gained $450,000 through this transaction. Who are the losers? Well, the minority shareholders that don't have the opportunity to force the company to sell discounted assets to their wholly owned subsidiaries are the losers. Those are the people that lost the $450,000 that Carlos Slim made. Now, my example here is a bit strange. The numbers are really small. Instead of thousands, think millions, and you can start to see how Carlos Slim became the world's richest man. Okay, now let's talk about preferred stock. Preferred stock is different than common in that it has preference over common for dividends and residual assets at liquidation. What does that mean? Well, think about a line of people at a corporation, and they're lined up in the order that they get paid. And so the people at the very front of the line are the government or the tax collectors. They'll get paid first, and then the employees and maybe some short-term creditors like suppliers. Then you'll have bankers, and then you'll have senior bondholders, junior bondholders, subordinated bondholders, and then right behind them in line are the preferred shareholders. And at the very end of the line, behind the preferred shareholders, are the common shareholders. And so preferred stock has preference over common. In other words, they're in line in front of them when dividends are handed out or when they're divvying up residual assets at liquidation. Now, preferred stock has a stated liquidation value, usually $100 per share. And what this means is that before common shareholders can get anything, the preferred shareholders have to get $100 per share. If there's only enough money to give each preferred shareholder $99 per share, then that's what they'll get, and the common shareholders won't get anything. And then we have the difference between cumulative and non-cumulative dividends. With common shares, if you don't get your dividend, if they skip paying a dividend, there's nothing you can do, and it's not made up to you later. We call that a non-cumulative dividend. In other words, if you miss the dividend, you're just out of luck. But some preferred stock, in fact most, has what's called cumulative dividends. What that means is, if the firm fails to make the dividend payment, then that becomes what's known as a dividend in arrears. And before they can pay any dividends to the common shareholders, they have to pay all those dividends in arrears plus the current dividend that's owed preferred shareholders before they can pay anything to common shareholders. Now, why is this a good thing? Well, managers typically have common shares, so in order for them to receive their dividends, they have to take care of the preferred shareholders, and so this gives them an incentive to do so. One more thing to know about preferred stock is that the dividend is fixed. In other words, you receive the same dividend over and over and over again. And preferred stock has no maturity, and so in theory, The dividends of preferred stock is merely a perpetuity, and we already know how to calculate the value of such a perpetuity. Now, oftentimes people get preferred stock and debt confused. Preferred stock might look like debt, but it is not. Let's talk first about the similarities to debt. The stated liquidation value looks a whole lot like the face value on a bond. And those fixed dividends look a whole lot like coupons. And in fact, some preferred stock issues have ratings just like bonds. And also, some preferred issues have obligatory sinking funds, once again, just like bonds. So in these four ways, preferred stock looks a lot like debt. However, preferred stock is not debt. How do we know? Well, first of all, preferred dividends are not tax deductible to the issuer. Remember that interest on bonds is tax deductible. But the dividends from preferred are treated for tax purposes just like the dividends from common shares. And secondly, preferred shareholders cannot force the issuer into bankruptcy. If the company misses making a coupon payment to bondholders, those bondholders can force the company into bankruptcy. If the company misses paying a dividend to preferred shareholders, they cannot do anything. And so what we see here is that preferred stock is not debt. Before we leave preferred stock, I want to make one more point. The way that preferred stock is named is like this. It's 5% preferred. What that means is that the stock has a set dividend of 5% of its stated liquidation value every year. We said that the stated liquidation value of preferred stock is typically $100. And so 5% preferred would pay $5 per year. You may find this fact to be helpful to you in working your homework and exam problems. Okay, let's talk now about how stocks get sold. First of all, let's understand the distinction between the primary and the secondary market. The primary market is the first time that a stock gets sold. Now, this could be at the initial public offering, or if the firm offers stock later in what's called a seasoned equity offering. Both of those transactions would be known as primary market transactions. It's the first time that a given share of stock is available for sale to the public, as opposed to the secondary market. And that's where people who bought the stock, individual investors, mutual funds, pension funds, people who bought the stock, sell it to each other. So this is more like individual to individual. The company doesn't get any financial benefit whatsoever from a secondary market transaction, whereas the primary market transaction is how the firm raises external equity. Now let's understand the difference between dealers and brokers. A dealer is someone who holds an inventory and stands ready to buy or sell. They have a post-ask price, which is what they would sell to you for, and they have a posted bid price, which is what they would buy from you for. Now, the difference between these two is called the bid-ask spread, and of course they have to ask more than they bid or they would not make any money, because that difference, the spread, is where dealers make their profit. Contrast that with brokers. Brokers, unlike dealers, never take possession of the item being sold. They merely get buyers and sellers together and charge a commission for their efforts. And so brokers never own the stock in question. Dealers own the stock and hold it in inventory. And so we break down our markets in the U.S. into two different categories, dealer markets and auction markets. And the dealer markets are merely a network of dealers all hooked together. And our primary example of that would be Nasdaq. Nasdaq is merely a network of dealers where they can all enter their bid and ask prices for a given stock into the Nasdaq system. And the Nasdaq system then will display the best bid and ask prices for a given stock, so consumers and investors can see what the current prices are if they would like to buy or sell stock. There's something also called OTC or pink sheets. This is a lower level market for smaller and more thinly traded firms. Then the other side of the market activity in the U.S. are the auction markets, and examples of these would be NYSE and American Stock Exchange. If you picture in your head the brokers working in the pit, that's an auction market. That's got a physical location. You can't say that about a dealer market. For instance, if I ask you where Nasdaq is located, the answer is everywhere and nowhere, because there is no trading floor for Nasdaq that we can point to. But Nasdaq is everywhere because it flows through the internet, and as you listen to this, you probably have Wi-Fi. Therefore, Nasdaq is actually flowing through you right now. Now contrast that to the New York Stock Exchange and the American Stock Exchange. We know exactly where the New York Stock Exchange is, and before September 11th, you were actually able to go there and stand in the viewing gallery and see trading take place. It's a physical location. Now, the term auction market is a little misleading, so let's take this opportunity in the next few slides to discuss how business gets transacted at the New York Stock Exchange. In the past, people who could trade commission-free on the NYSE were called members, and they owned what was called a seat on the exchange. Then the New York Stock Exchange became a stockholder company, and everyone who owned a seat received a certain number of shares in exchange for that seat. Now, if you want to trade commission-free on the New York Stock Exchange, you have to be what is called a license holder, and you have to pay a certain amount every year. It was $40,000 in 2013 to be able to trade commission-free. And these license holders basically get broken down into three groups. The first are called designated market makers, or DMMs. In the past, we called these folks specialists, and you might think of them as mini dealers. They have a post on the floor of the exchange, and they hold a small inventory of stock, and they stand ready to buy or sell. And their job is to make sure that regardless of whether a person wants to buy or sell, that you can always do so. So they are the person who makes a market in the stock when other people are not interested in buying or selling. Their bid-ask spread is fairly wide, and it has to be because if no one else is interested in trading, there's probably some sort of risk that goes along with the act of buying or selling in the stock. Then there are people on the floor known as floor brokers. These are people who work for groups like Merrill Lynch or TD Ameritrade, and they are executing trades on behalf of clients. And the way they get paid is by commission. Every time I do a trade on TD Ameritrade, it costs me $10, and that $10 goes to these floor brokers and their parent firms. And then finally we have supplemental liquidity providers. These are people who trade for their own account, meaning they are not trading for clients in exchange for a commission. They are managing wealth. And they are a good thing to have around because they buy and sell on the market, which adds additional liquidity. That additional liquidity helps to make the market more liquid for the other folks who trade there, meaning that their trades will be less expensive. These supplemental liquidity providers, however, are not actually on the floor of the exchange. Only DMMs and floor brokers are allowed there. The New York Stock Exchange is now a hybrid market, meaning that it operates both electronically and with people on the floor. When a buy or sell order comes in, the first thing that happens is that a computer compares it against other open buy or sell orders. And if the computer finds a match, then the trade goes through and no human actually touches it. This is the way the majority of trades are made on the NYSE these days. However, if the orders cannot be matched up, then the order goes to the floor. And so then it'll be a floor broker working at the DMM's post who will attempt to make the trade. The DMM is standing there with a posted bid and ask price. And so the floor broker could, in theory, just go up to the DMM and make the trade. However, it is the responsibility of the broker to seek best execution for their client. In other words, if they're selling, to get the highest price, and if they're buying, to get the lowest price. And so the brokers will work the order and try to trade in the crowd. Failing to find someone in the crowd to trade with, they will go ahead and trade with the DMM. Now, if they find someone to trade with in the crowd, what they will usually do is split the difference between the DMM's bid and ask price with the other broker, and that way both of them come out better. The seller gets more money for their stock, and the buyer pays less for theirs. The Nasdaq is a completely electronic stock market. You can't go somewhere and see the trading floor of the Nasdaq because it doesn't exist. It's just a computer network connecting dealers, and each day those dealers put in their bid and ask prices, in fact, at multiple points throughout the day. And then the computer system at the Nasdaq displays the inside quotes, the highest bid price and the lowest ask price, so people can get the best execution for their trades on Nasdaq. Now, Nasdaq is a multiple market maker system. Remember, on the floor of the New York Stock Exchange, we only had one market maker, the DMM, per stock. But with Nasdaq, you have many people offering to buy or sell the stock, these dealers. And so there's always lots of liquidity for most stocks because they have more than one market maker. As of late, electronic communication networks have also been able to post their bid and ask prices. In other words, these are just individual traders or investors that can go out there and post their own bid and ask on Nasdaq. And so you can actually become a dealer. Of course, that's extraordinarily dangerous, but many people like to do that. The other thing that electronic communication networks allow is after-hours trading. If you go out and look at a stock quote after the stock markets have shut down for the day, you will see after-hours prices posted if the stock has traded since the stock closed on its regular market. Those trades have occurred over electronic communication networks. So if you're trading at 3 o'clock in the morning in the United States, you might think that you were trading with someone in China because of the time difference, but in truth it could be a guy in Denver in his boxer shorts behind his own computer making trades in the middle of the night via an electronic communication network. Now I'm going to teach you how to read a stock quote. Here we have a stock quotation for Apple on Yahoo Finance. And this is live. We are looking at it as it trades here. And it appears, right now it is 3:12 p.m. in New York. It appears that it hasn't traded for 3 minutes. Let's refresh and see if that's true. No. Okay, so apparently this doesn't update on a live basis. So we have Apple here, and it used to be if you saw a 4-letter ticker symbol like AAPL, you would know that the stock traded on Nasdaq, but that's not the case anymore. You will see 2- and 3-letter ticker symbols on Nasdaq and 4-letter ticker symbols on the New York Stock Exchange, so things have gotten kind of hybridized. Right now, Apple stock is trading at $127.78 per share. That is down 33 cents from yesterday's close. Yesterday's close, then, if we added 33 cents to 127.78, we would see was 128.11, which is exactly what it says here. and this also tells us that the stock is down 0.26%. It opened this morning at $128.94. Now I want you to notice that the stock doesn't have to open at the same price that it closed at on the previous trading day. That's because news comes in overnight and changes what people think the stock is worth. And so it could either open higher or lower. It would only be by coincidence that it opened the same. Moving on down, we see the bid and the ask price. If you were to sell your stock as an individual investor, you would receive the bid price. At current, you could sell up to 1,800 shares at $127.65. How do I know you could sell 1,800 shares? We have the depth of the quote right there, 1,800 shares. Now you could sell more than 1,800 shares if you wanted to, but you would have to accept less money for everything over 1,800. The ask is what you would have to pay if you were going to buy shares. And right now you could buy up to 600 shares for $127.66. You could buy more than 600 shares if you wanted to, but you would have to pay more than $127.66 for everything over 600 shares. Moving on down, we have the 1-year target estimate. People called equity analysts often make estimates of what they think the stock price will be in 1 year, and this is the average of their estimates. Now, is this a sure thing? Absolutely not. If it were, then everyone would invest in Apple stock instead of 3-month treasury bills because it would be risk-free. So this is not a sure thing. This is just the best guess. Then we have the beta for the stock. Remember that a beta of 1 would be identically risky as the market. Apple has gotten to be so big and so diversified that now it is close to having similar risk as the overall market. Then we see down here the next anticipated earnings date. Many companies announce their earning dates well in advance. This is when they report earnings. Apple, though, apparently is not as judicious at putting those sorts of things out there. And so this is their best guess of when Apple's going to announce their earnings. When a firm announces their earnings, then that creates the lowest information asymmetry of the period. In other words, the company has now announced to everybody what the earnings are. But then, as time goes on between the earnings announcements, which happen every 3 months, the information asymmetry grows. In other words, the insiders have a better idea about what the next earnings are going to be than the outsiders. And that gets worse and worse and worse until the night before the earnings data or the earnings announcement, at which point it's at its absolute greatest. And then they make the earnings announcement, and then the information asymmetry between insiders and outsiders reduces again. Up here at the top we see the day's range. This stock has traded between 127.56 and 129.20. Apparently something has happened here that's made the stock go down quite a bit in price. The 52-week range is between 89.80 and 134.54. Now, a lot of times people get confused and they think that if the stock is near the bottom of the 52-week range, then it's cheap, or perhaps it's on sale. Well, what if the company is dying? Won't the stock price always be near the 52-week low? And just because the stock is near the 52-week high, does that mean that it's too expensive and you shouldn't buy it? Well, a stock that is in general going up over time will be at or near the 52-week high. In fact, let's click here on 1 year and see what Apple has been doing. You can see that Apple has been going up over the last year, so it's no surprise whatsoever that Apple is near its 52-week high. Does that mean that Apple isn't going up anymore? Well, if you'd thought that through here, you would have been absolutely wrong. So what can you tell from this 52-week range? Not much. The volume in Apple shares today, that's the number of shares that have changed hands, is around 24 million. The average volume on an average day over the last 3 months has been 45 million, so this has been a relatively quiet day for Apple. The stock is getting close to the close here. We're within 48 minutes of the close, and so it should be right now close to that 45 million if we were having an average day. The market capitalization of Apple is merely the share price times the number of shares outstanding. So we could take this market capitalization of $736 billion and divide by the share price and figure out how many shares are outstanding. So I'll do that right now on my calculator. And I'm getting that they've got 5.76 billion shares outstanding. Next we have the PE ratio, that's price earnings ratio, and it's around 15.88 today. Now we say today, that's today's price divided by earnings. And what are those earnings based on? TTM tells us trailing 12 months. There's another way to look at PE, and that would be a forward-looking PE, where we use the forecast of the next year's worth of earnings. But that would be inaccurate because we don't know those future earnings with certainty. We do know the prior earnings with certainty, but if we depend on that, it's like driving your car looking in the rear view mirror. Next we have earnings per share. This is where we take the net income of the firm over the last 12 months and divide it by the number of shares outstanding. And here we have $8.05 per share. So if we took that $8.05 per share and multiplied it by the number of shares outstanding from earlier, we would see that their net income in the last year has been $46.38 billion. And finally we have the dividend and the yield. This dividend amount that we're given is actually the annual amounts of dividends paid. But dividends are typically paid every quarter. So what we're looking at here isn't $2.08 once per year. It's 52 cents 4 times per year. And that dividend yield, if we take $2.08 and divide by the current price of $127.78, I get 1.63%. For some reason, I always get a slightly different yield than Yahoo Finance. I don't know exactly what number they use to calculate, but that's where we're at. Theirs with 1.6% is the dividend yield.